How's it going, everybody? It's your boy, Homie G, and I'm back. All right, my little homies. So today I got a very important lesson for you. Something you probably will never be taught in school. And that is, how do taxes work? This is lesson 1, because there will be 2 or 3 other lessons. Because the tax code, the US tax code, and how taxes work in this country is quite complicated, which is probably why your teachers do not teach it, okay? Because maybe they themselves don't understand how taxes work. They know they have to pay taxes, just like everybody else who works knows they have to pay taxes. But maybe they don't know how to reduce their taxes because they've never been taught themselves. Maybe they've never read the US tax code, a very thick manual that tells you exactly how you can reduce your taxes. And let me tell you right now, taxes are a wealth killer. If you want to be rich one day, if you want to be wealthy one day, you want to be the first in your family to be wealthy, you need to tax plan from January 1st all the way to December 31st. You need to tax plan. You got to have reducing your taxes always at the top of your mind, because otherwise you will pay a lot in taxes. Okay, so lesson number 1 is going to be all about something called earned income. Earned income. Earned income, my little homies, earned income is the worst type of income that you could possibly make after high school. And the type of income you're probably going to make after high school. Now, why do I say that? I say that because public schools aren't equipped to teach you how to not pay a lot in taxes. If you've ever read the book Rich Dad, Poor Dad, and if you have not, I suggest you do. And then the follow-up book that Mr. Kiyosaki wrote, or, authored, the Rich Dad Quadrants, the Quadrants, Mr. Kiyosaki details that there are really 4 types of tax-paying Americans. So I'm going to really quickly draw his quadrant. This is not my quadrant, it's his quadrant. Here we have the E, which stands for employee. E, employee. That means you have a boss. You have a boss. Has a boss. You work for someone. You work for a company. You do not have a business. It's not your business. You work for somebody else. And then the S's, which are self-employed or specialist people. Self-employed. These people might have a business, a small business, less than 50 employees. Okay, 50 employees. So who can they be? They could be a plumber, has a business. They could be painter with a business, a landscaper with a business. They could be even a specialist. S is also for specialist. These could be, for example, a dentist. A dentist went to school, became highly specialized in the dental field, and now they have their own practice. And who else? It could be a psychiatrist, or a psych, or a psychologist. They have a private practice. Maybe it's running out of their home, whatever. So these are all the S's that are specialists, are the highly educated college graduates. Maybe they even went to grad school and got masters. But we also know that we have people hustling out there, starting their own little businesses, and they employ a few people. They too get taxed a lot. These 2 types of Americans, employees and self-employeds, get taxed the most. And guess what? That's what public schools teach you to do or to be. You're either going to flunk out of high school, or you're going to barely graduate high school, and your income generating prospects are going to be very poor. Okay? You're going to have to go work for Amazon at the warehouse, or you're going to have to work at Walmart, or you're going to have to be maybe a barista at Starbucks, or work And these are not, I'm not saying these jobs are bad, my little homies. I'm just saying that you're going to be an employee. You're going to be an hourly paid employee, hourly paid. And of course, everybody wants to get paid the most hourly, right? You're not going to go to a job and be settling for whatever they give you. Over time, you're going to want them to increase your hourly pay. And then some of these employees too are also salary, like yours truly. I get paid a salary by the school district. Okay? So I actually belong to an employee myself as a teacher. And I didn't know this when I was younger. I wish someone had taught me. Okay, now that we have the background here on who's who, and now that we've mentioned, or I mentioned, whoa, now that I mentioned that these two types of Americans, E's and S's, employees and self-employed, get taxed the most, let's see why. Okay, so the U.S. tax code is a very thick manual that explains how Americans can reduce their taxes. Okay, and the government incentivizes people to reduce their taxes by being big business owners, people like Jeff Bezos, people like Elon Musk, who are big business owners. They employ hundreds of people because the government doesn't want to be in that business. You see, the government is not as good as a private citizen in creating jobs. And nobody wants the government to create jobs anyways. Politically speaking, we don't want big governments, right? We don't want them to be employing everybody. So the government incentivizes the private citizen to create big businesses that could put a lot of people to work. And so they will reward these people with lower taxes. And the same goes for the investor class. And those, again, big B would go here, big business, and the investor class goes here. The government wants people to be investors because investors could be somebody like a land developer who can build a development of houses and put up 50 houses in a row or maybe more, apartment buildings and whatever. And again, the government doesn't want to be in the business of providing housing. They know private citizens could do a better job, so they incentivize people by reducing their taxes to become investors. That's in the tax code. Same thing with big business owners. But let's focus on the employees and the self-employed, okay, who are constantly trying to make more money, okay? The more money the E's and the S's make, the more they're going to get taxed. Why? Because in this country, we have something called federal and state tax brackets. But I'm just going to focus on the federal. You get taxed by the government, Uncle Sam, right? Uncle Sam. You get taxed by the federal government, and you get taxed at the state level as well. Okay? So whatever state you live in, you're going to get taxed by your state income taxes, and federal. You're going to pay two types of taxes. They're going to be taken out of your paycheck. But why do these individuals pay the most? Because these individuals, the E's and the S's, I'm an E. I work with a school district, so it's happening to me too. They get their income put into something called tax brackets. Tax brackets. Now I'm going to pause this video. Well, not yet. I'll pause it later. But what are these tax brackets? Okay, so there's something called marginal tax rates. Marginal tax rates that Americans have their income put into, taxable income, and they scale downward. They start at 10% for a portion of your income. It's up to like $10,000 of your income that you make. That is taxable, actually. That's a taxable income, because not all of your income ends up being taxable. Not all of your gross income that you make for the year ends up being taxable. There's such things called deductions that help a little bit. Not these two types of Americans. They have very few deductions. These two, the big B and the I's, have the most deductions. That's why they can lower their taxable income. So when you file a tax return, at the very bottom of the first page, right after your name and your social security number, there's going to be one line at the bottom that says taxable income. This is the money, the income that the government can tax you for, okay? Can tax you for, well, that you're responsible to pay a set amount of taxes for. So the marginal tax rates, they come down. That you could actually look these up, and I suggest you do. And I will put a picture when we talk about what this high-paid doctor pays in taxes a little bit later. But they start at 10% for like $10,000 of your income. And then they come down to 12%. Next is 12% bracket for between this amount and the next amount, up to $41,775. 10%, 12%. So far, it's not bad, right? A 10% rate for some income. So if you make less than $41,000 a year, your marginal tax rate is going to be in between 10 and 12%, maybe 11%, somewhere in the middle. But if you make more than 41,000, you're already going to go down to another bracket. You're going to go down to the 22% bracket. Woohoo! So now you are between all the way up to $89,000 now. If you have a taxable income amount of $89,000, you're going to have some of your money. Some's going to go into this bracket up to that amount. Some's going to go into this pool up to that amount, and whatever you have remaining is going to go into this pool, the 22% bracket, and going to be taxed at 22%. Okay, and what happens? It keeps going up. 24%. Notice up to $170,000 now. Okay, who makes $170,000? Who makes that amount of money taxable income wise? Ballers. Hello. You know, doctors, dentists, self-employed people that work themselves to death. Yeah, so there's a lot of Americans that make that amount of money. So you can see now we're going down lower, more, higher tax rate. Next one's 32%. Okay, all the way up to $215,000 of taxable income. And then the last one, well, it's not the last one, 35%. All the way down to, and you probably can't see this, but it's all the way to $539,000. So what's the trend here? Basically, what is the trend? The more money you make, the more of your hard-earned money goes into the higher tax brackets down below. Okay? And so what happens is then you take these percents to calculate your taxes. You take these percents, you convert them to decimals, and you multiply times the amount you got in each of these brackets of your taxable income, and then you get an amount. You get a taxed amount from that. So I'm going to pause the video and show you what happens if you're, let's say, a doctor and you're single, because it's different for married couples. The rates stay the same, but the amounts change if you're married. So if you're an E or an S, what happens? Say you went to school because your teacher told you, go to school, get good grades, get a great education in college, get a high-paying job, and then you wanted to go to med school. You wanted to be a doctor. Yeah, go become a doctor. All right. So let's say you're starting out working in California, and you're making, after you got out of medical school, resident, whatever, you're making $250,000 a year. It's not bad. How much are you going to pay in taxes? I'm going to pause the video, and then I'm going to show you a picture of exactly how much you would pay if you have a taxable income amount as a doctor of $250,000. Let's say that's your taxable income for the year for 2021. How much would you pay? Now, let's make it 2022 because these rates are 2022. How much would you pay in taxes? I'm going to stop it for a second, then we'll come back. And we're back. Okay, so you should have seen that a doctor with $250,000 of taxable income has to pay just federal, not state, federal taxes in the amount of $61,250. So they worked all year making, a lot of money, but what happened? in the end, because of those marginal tax rates, because of the tax bracket that you saw, where you see it escalating from 10 all the way to 37%, the more money you make, the more income you have, 37% rates, they get punished. People who make a lot of money, who are E's and S's, employees and self-employeds, are punished by the U.S. tax code, okay? Because they have to pay the most in taxes. So what happened? What happens? What's the moral of the story? The moral of the story is we really shouldn't be teaching students to be high-paid employees and self-employed people, right? We should really be teaching our students to be big-time business owners. This involves taking a little bit more risk, and investors. Or at least, if we're going to pump E's and S's out as teachers, we should at least be teaching them that this is going to happen to them, and they're going to need to, as they go from year 1 of their careers to year 30, whenever they just decide to retire, to start converting some of this earned income into a different type of income, which I'm going to talk about in another lesson. So that's what I'm doing. I'm taking, as an employee, as a teacher, I'm taking my crappy income. I'm sorry I said that, but it's true. Earned income is the worst, as you saw. I'm taking some of this earned income and converting it into another form of income. Okay? All right, my little homies. So I hope you have learned this very valuable lesson on taxes. Remember, today we learned earned income sucks, number 1. Number 2, you're going to come out of high school and most likely be an E or an S. And the number 3, the third part of this lesson was, as you saw from the tax brackets, the more money you make, the more of your money that's taxable goes into the bottom bracket, part of the bracket, which are the higher rates, which means more taxes that you have to pay. All right, and I'm out. Deuces.